One of the most profitable software companies on the planet is currently trading at a lower earnings multiple than a mid-tier industrial manufacturer. Think about that for a second. A business generating nearly $10 billion in free cash flow every year with 89% gross margins, a near monopoly in creative software, and double-digit revenue growth, priced like something boring and slow. That's not a typo. That's Adobe right now at around $270 a share. And the question that should immediately follow is, why? Is the market seeing something real? Is this a value trap dressed up in quality metrics? Or is this the kind of pricing dislocation that only makes sense in retrospect, once it's already gone? That's what we're going to work through. But before the numbers can land properly, you need to fix something. Because most people's picture of what Adobe actually is about 15 years out of date. Most people think of Adobe as the company that makes Photoshop. That's accurate the way saying Amazon sells books is accurate. True, and almost entirely beside the point. Adobe today is 3 distinct cloud businesses running on subscription economics. Creative Cloud covers Photoshop, Illustrator, Premiere, and the rest of the Creative Suite. Roughly 30 million paying users who have built their entire professional workflow inside Adobe's ecosystem. Document Cloud is Acrobat and PDF infrastructure, embedded in legal, financial, and enterprise operations at a scale most people don't appreciate. And Experience Cloud is the enterprise play. Marketing analytics, customer journey management, and content personalization for Fortune 500 companies on multi-year contracts. These are not the same business wearing the same brand. They have different buyers, different switching costs, and different growth trajectories. What they share is the structural characteristic that makes Adobe worth studying. Once you're inside, leaving is genuinely painful. Not because of contractual lock-in, but because the workflow dependency runs deep. A creative director isn't switching off Photoshop mid-project cycle. A legal department isn't rebuilding its PDF signing infrastructure around a new vendor to save 15%. The clear signal of how defensible this position is came in 2023 when Adobe tried to acquire Figma for $20 billion. Figma was a credible design tool with a younger user base and a browser-native architecture that Adobe couldn't easily replicate. The deal got blocked on antitrust grounds. But the willingness to spend $20 billion to eliminate one competitor tells you exactly what management believed about the value of keeping the moat intact. When you see the business this way, not as a software catalog, but as recurring revenue infrastructure with deep workflow embedding, the financial results stop looking exceptional. They start looking inevitable. Fiscal 2025 closed with $23.8 billion in revenue, up 10.5% year over year. Gross margin at 89.3%. Operating income at $8.7 billion. Free cash flow just under $10 billion. That FCF margin, north of 40%, is structurally rare at this scale. It means Adobe converts more than 40 cents of every revenue dollar into actual cash after all costs. Not accounting earnings, cash. The balance sheet is clean. Net debt under $7 billion. Debt to EBITDA below 1 times. ROE at 59%. ROIC above 35%. These are not numbers you find in a business with fragile competitive positioning. The capital return story is underappreciated. Adobe pays no dividend, so it doesn't show up in yield screens. What it does instead is buy back its own shares at roughly 6% of the float per year. Compound that over a 5-year hold. The share count reduction alone is a meaningful component of the per-share value build, and it's funded entirely by free cash flow with nothing drawn on leverage. The blunt version? This is a business that doesn't need favorable conditions to generate exceptional returns. It doesn't need rates to fall, multiples to expand, or an economic boom. It needs the market for creative software and enterprise digital experience to remain roughly where it is. Given that both are structural, not cyclical, that's not a heroic assumption. The question that follows naturally is, if the business is this clean, Why does the valuation look the way it does? Trailing PE around 16 times, forward PE near 11.5 times. EV over EBI TDA at 11.2 times. For context, Salesforce trades at roughly 18 times EBI TDA, Autodesk at 20 times, ServiceNow considerably higher. Adobe, with demonstrably superior gross margins and free cash flow conversion than any of them, trades at a discount to the group. The PEG ratio sits at 0.76, below 1. For a business growing earnings at double digits, that's the kind of reading that tends to attract serious long-term capital, because it implies the market is not pricing the growth into the stock. It's pricing something closer to stagnation. Wall Street's own consensus makes the disconnect visible. 26 analysts cover the stock. The average 12-month price target is around $383, roughly 42% above where the stock trades today. Even the bears aren't calling this overvalued. Goldman's skeptical case sits near $290, which is essentially flat. The bull case reaches $585. That range, from $290 to $585, is telling. It's not uncertainty about whether Adobe is a good business. Everyone agrees it is. It's uncertainty about one specific question. What does the AI transformation actually do to Adobe's growth rate and pricing power? That's the variable the market can't agree on. And that uncertainty is precisely why the stock is priced the way it is. Here's a genuine question worth sitting with. If someone offered you a business generating $10 billion in free cash flow annually, growing revenue at 10% or better, with minimal debt and a decades-long track record of execution, what would you pay for it? Not what the model says. What would you actually pay? Whatever your answer, it's probably north of $270. Adobe's Firefly generative AI is already deployed. It's inside Photoshop, Illustrator, and Acrobat today, not on a roadmap slide. That matters because the conversation about Adobe and AI is often framed as a future possibility, when the product reality is more advanced than that framing suggests. The strategic question is not whether Adobe can build AI. They have. The question is whether they can monetize it, meaning, can they use AI capability to justify higher subscription tiers, and can they convert that pricing power into accelerated revenue growth? The Acrobat AI Assistant is a clean test case. It turns a product that tens of millions of companies already pay for into an active intelligence layer, summarizing documents, answering questions about contract terms, extracting structured data from unstructured files. The marginal cost of delivering that is low. The willingness to pay for it, in legal and financial services especially, is high. That's the monetization structure Adobe is building toward. Experience Cloud is the more contested play. This is where Adobe runs directly into Salesforce and Microsoft, both of which have significant distribution advantages in enterprise. Adobe's differentiation is on the content side, the ability to generate, personalize, and deliver creative assets at scale through the same platform that produces them. Whether that is enough to win enterprise contracts at a premium is the honest, open question. And here's the risk that doesn't get enough attention. Adobe could build genuinely excellent AI features and still fail to capture the value because enterprise buyers negotiate hard, competitors match the functionality, and the AI benefit lands in the platform's stickiness rather than in the pricing line. A useful signal to watch: the people around you who use creative software professionally. Have Adobe's AI tools changed their workflow in a meaningful way? Not in a demo, in actual daily use. Because the answer to that question, multiplied across millions of users, is something no analyst model fully captures. 3 risks deserve honest treatment, not hand-waving, actual assessment. Canva is real. It has grown into a credible mid-market design tool with over 150 million users and an active push into enterprise. It doesn't threaten Photoshop at the professional level, but it is capping Adobe's addressable market at the entry tier and creating genuine pricing pressure for the casual to intermediate user segment. Adobe's response? simplified consumer tiers and Firefly's accessibility features is the right strategic move, but it's not fully tested yet. Microsoft is the structural concern. 365 Copilot integrates AI-assisted design, document generation, and content tools into a platform that most enterprise employees already access every day. The distribution advantage is enormous. Adobe's answer is that Microsoft operates in generalist territory. It can help a manager make a decent slide deck, but it cannot replace a professional creative workflow. That distinction is real, but it's not permanent. The question is whether Microsoft's footprint expands fast enough to erode Adobe's pricing power before Adobe locks in AI tier upgrades. Subscription fatigue in enterprise is subtler but worth naming. CFOs are scrutinizing SaaS renewals more carefully than they were 2 years ago. Multi-year contracts that auto-renew at list price are getting pushback. Adobe's renewal rates remain strong, but this is an environment where vendor consolidation is an active trend, and Adobe, with 3 distinct cloud products, is not immune to that conversation. The honest counterweight? Adobe's balance sheet absorbs a bad year without strategic distress. The FCF generation means even a growth slowdown doesn't threaten the business model. And the bear case scenario, at $250 to $280, represents very limited downside from current levels. That asymmetry matters. Which of these risks do you think the market is most underpricing? That's worth holding as a question while watching the next few earnings calls, because the answer will show up in the guidance language before it shows up in the numbers. Base case, 70% probability. Revenue growth holds at 10 to 12%. AI monetization proves real but gradual. Premium tier adoption builds steadily over 2 to 3 years, not overnight. Margins expand modestly. Buybacks continue compressing the share count, and the multiple re-rates toward software peers as the AI story becomes more concrete. Price target range, $400 to $450 over 3 to 5 years. Annualized return from current levels, roughly 15%. Bull case, 20% probability. AI pricing tiers accelerate faster than consensus expects. Experience Cloud breaks into enterprise at meaningful scale. EPS growth runs at 15% or better. Multiple expansion follows growth re-acceleration. Price target, $500 to $550. Bear case, 10% probability. A macro contraction hits creative and enterprise spending simultaneously. Canva and Microsoft make real market share gains in the mid-market. Multiple compresses further rather than expanding. Price target, $250 to $280. Roughly flat or a modest drawdown from here. The probability-weighted expected value across these scenarios points well above $270. That's the asymmetry. It doesn't require the bull case to be right. It only requires the base case not to fail. The market occasionally prices excellent businesses as if they are ordinary ones. When it does, there's almost always a specific fear driving the discount, a threat that feels large and poorly understood. For Adobe, that fear is AI disruption. The concern that the tools being built to replace creative work will hollow out the market for creative software. But Adobe is not being disrupted by AI. It's deploying it. The distinction between a company that AI threatens and a company that AI extends is the entire investment question here. And right now, the price suggests the market hasn't fully resolved which one Adobe is. That resolution, over the next 3 to 5 years, is where the return lives. This video is for educational purposes only and does not constitute financial advice. Every investment involves risk, and you are responsible for your own research and decisions. Nothing here should be taken as a recommendation to buy or sell any security.